So today we're going to cover milestone number 4, the next dollar roadmap. At this point, we've already covered the starting point, which was the budget. Milestone number 1 was the uh-oh fund, or the value of your highest insurance deductible. Milestone number 2 is contributing up to your employer match, getting employer matching contributions in either 401k or HSA or FSA, stuff like that. Milestone number 3 was paying off toxic debt. And now we're going to talk about milestone number 4, which is fully funding your emergency fund. Now, all the previous videos I just referenced are linked down below, and I'll add all the subsequent videos that come after this one as I post those to YouTube. So to start off today, I want to give a personal story to kind of set the foundation or be a baseline for us as we talk about a fully funded emergency fund. In November 2015, I was actually laid off from a job. The company I worked for ran into some financial distress, and many of us were given the opportunity to seek employment elsewhere. And I'd never really expected that to happen. But at the time, I've had 3 to 6 months of expenses saved in an emergency fund, and it gave me a lot of peace of mind and helped me to not panic as I looked for another job elsewhere. Fortunately, the job market was relatively healthy at the time, so I was only unemployed for a few months. But having the emergency fund was huge for just peace of mind for me, for my family, as we kind of navigated that uncertainty. Now, having a cash reserve of several months of expenses is something we should all strive to have, because uncertainty will visit every one of us sooner or later. You could have an unexpected illness, an expensive home repair, economic turmoil, pandemics, disability. There's no end to the number of hazards that could force you in a position where you suddenly need a large reserve of cash to protect your financial goals. But how much should you save? Well, like many financial questions, the answer depends on the circumstances of your situation. There are a lot of variables that can push the needle in a lot of different directions. Now, this video is generally going to serve as a guide more than provide you with a hard number that you need to reach. In order to know how much money you need to know how much money you spend, which means you need to do a budget. And you can take a look back at our video, the starting point, that's 4 videos back about budgeting, which is linked below. Now, the widely accepted rule of thumb is 3 to 6 months of expenses for a fully funded emergency fund. This is actually a pretty broad range, and I'd recommend tuning your emergency fund to your circumstances based on a few considerations. You're probably safe on the smaller, the 3 to 4 month range if you have a very secure job, like you're a teacher with tenure, or your health is in really good place, or you don't have any debt. Maybe you have more than one stream of income, like you have income from multiple sources. If you share finances with someone else that's working, that's kind of like multiple streams of income. It diversifies the income opportunities. If you think it'd be very easy for you to find another job if you lose the job you have, if your home and your car are both in great operational shape, in other words, it's unlikely that you're going to have an emergency with either of those assets anytime soon. If you're renting and you think you can find a cheaper place to live quickly, like there's a lot of flexibility there. If you don't have anyone else depending on your income, that gives you a little more flexibility and freedom to have a smaller emergency fund. And finally, if you have significant Roth contributions that are available in an IRA that you could access if you had to in an emergency, I guess technically that could be an emergency fund, but I really prefer that you not touch Roth assets, to be honest. Now, you should probably lean more toward the 6 month or more end if your job isn't very secure, if you have poor health, if you have a lot of debt, or say your income fluctuates, or it's heavily dependent on commission, or dependent on economic conditions, things like that. If it would take you several months to find another job, or even up to a year. If you're driving a really bad car, or that your house is in bad shape and you think you may have to replace some of those things soon. If you have dependents depending on you for your income, or you own a home, these are all reasons that you may want to have the longer 6 month or more end of expenses saved in your emergency fund. And finally, for reasons I'll discuss more in milestone number 8, as you approach retirement, I'd suggest having around 2 years worth of expenses available in your emergency fund. Now, there are also some strategies that allow you to mitigate the unforeseen, allowing you to hold a smaller emergency fund. The first is if you build multiple income streams. Just like you can diversify a portfolio through different investments, having multiple sources of income can also be a great way to safeguard your finances. Now, there are lots of possibilities and ways to produce multiple streams of income, but I'd recommend by starting to try and find a way to monetize a skill set or an interest that you already have. Now, second option is to build a unique skill set. Skills that are highly sought after but difficult to come by are great for securing the job you already have, while improving your prospects should you need to move on to another job. So be sure to take advantage of opportunities to hone, refine, or specialize your skill set whenever those opportunities present themselves. Now, this may require working out of your comfort zone for a bit or solving some complicated problem, but in the long run, it might make you a very difficult person to lose within your company. Another way to mitigate your emergency fund size is to know your disability and long-term care benefits. You may have benefits from your employer to back up your income in certain circumstances, and these options are most often available to a health-related income loss. You're probably also covered by a government-sponsored unemployment insurance plan that both you and your employer have been contributing to during your working time. Another good way to reduce your emergency needs is to decrease the amount of debt you have. Obviously, it'll be easier to get by if you have fewer bills to pay. Okay, so now that we've made the case for having an emergency fund, where should you put it? Before I share some ideas, here are some key things to remember about emergency funds. First, emergencies aren't something that you can time. And second, because of that, you may need to be able to access emergency funds relatively quickly. And third, you don't want your emergency funds value to be exposed to possible fluctuations in asset prices, so no stocks. And finally, you don't want to put your emergency fund anywhere where you could risk losing it entirely. Now, unfortunately, these requirements limit where you can actually responsibly store your emergency fund assets. Real estate is not a good option because it can take a long time to liquidate, and it's subject to sudden changes in value, which may mean you have to sell your investment at a loss. Like I already mentioned, stocks, bonds, and mutual funds are also subject to sudden price fluctuations, meaning they can decrease in value suddenly. And while it doesn't take as long as real estate to liquidate, it can still take several days for the sale of equities to settle so the money can be accessed. Finally, don't put cash under your mattress or stored somewhere in your house. Your house could burn down, your dog could find it and eat it. You may forget about it. It may get stolen by the cleaning ladies. I don't know. There are lots of reasons that just sticking it somewhere in your home is less secure than a bank. Now, ultimately, the investment options for an emergency fund are not very exciting, but here are some possibilities you may want to consider to gain a little bit of interest off that money without exposing yourself to unnecessary risk. The first one is high-yield savings accounts. I use the words high yield very loosely here. These accounts produce more interest than a typical savings account at a local bank, but it's still not necessarily anything amazing. You'll likely find the best options for high yield savings accounts with online banks. They can give a little extra interest because they don't have a lot of overhead that brick and mortar banks have to cover. Now, one thing to watch out for in these accounts is an introductory rate, or a rate that changes or fluctuates, that's designed to attract you in, get you to sign up only to decrease later, kind of like a bait and switch scheme. Some banks will even offer cash incentives to sign up, but generally you'll be better off going with the option that has the longest history of paying out a solid interest rate. Also, you want to be sure that you choose an institution that's FDIC insured. And that's important because it backs up your money in case the bank that the money is in fails. Now, each individual that's named on the account receives $250,000 of FDIC coverage. So if you co-own an account with a spouse, you'll have $500,000 in coverage. A second option is money markets. There's two different types. Money market accounts are available at a brick and mortar bank, and they combine a slightly better interest rate with a lot of restrictions and access to your money compared to a traditional savings account. Now, money market funds, on the other hand, work like a mutual fund that holds a variety of cash equivalents like CDs, short-term notes, treasuries, things like that. And typically, money market funds will produce higher yields than money market accounts, and they're a lot more flexible. Now, money market funds and accounts technically do come with an inherent risk of loss, but it is relatively low. And even if you did lose a little money on these accounts, you're not likely to see much of a dip. Next on the list are certificates of deposits, or CDs. CDs are an agreement you make with a bank to keep the deposited funds for a specific period of time. If you remove the money before the CD matures, you'll forfeit the interest you've earned, or you may even have to pay a fee. Now, CDs do not provide much flexibility, so many times people will build a CD ladder with a variety of maturity dates so that there's always some cash reaching maturity. So they need it, they can pull it out whenever those CDs mature. Now, personally, I don't prefer to use CDs because I find them to be a little restrictive for the interest that you can earn when you compare them to other investment options. Next is checking accounts. You probably don't need a lot of explanation on how a checking account works, but they are a practical way to hold money in an FDI insured account while providing access to your money. The downsides of a checking account are higher risk of losing your money if someone manages to steal your debit card, which is still pretty remote. And there's not much interest, if any, in a checking account. Another drawback of keeping your emergency fund in a checking account is there's a good chance it's commingled with money that you're spending regularly. So if you're not very disciplined, you could spend your emergency fund either by mistake or sort of by mistake. Now, for all these reasons, checking accounts would not be at the top of my list, but mostly because they don't produce much, if any, interest. So summarizing, a fully funded emergency fund is not the most exciting milestone on the next dollar roadmap. For one thing, it takes time and discipline to build 3 to 6 months of expenses, and then after you have it, The purpose of the money is really just to sit there. You can't even invest it in anything exciting, so it's a bit of a downer. However, if you need a fully funded emergency fund and you have it, then it's incredible, right? A fully funded emergency fund is absolutely necessary for building and protecting wealth. Trying to maintain a significant net worth without an emergency fund is like riding a motorcycle without a helmet. Be smart. Get your hands on some cash before moving on to milestone 5. And speaking of milestone number 5, this is where things get really exciting to me on the Next Dollar Roadmap, because you're going to start setting aside 15 to 25% of your income in tax advantage retirement accounts, meaning this is really where you start to see your net worth grow significantly. As always, I am grateful for your interest and your time. God bless and take care.